78 apartment units in 18 months. If you're interested in a blueprint for fast growth, pay attention. This video will inspire you. Let's go! Hey gang, Russell Westcott here. I help real estate investors like you start, grow, and scale the real estate investing portfolio of your dreams. Real estate investors, entrepreneurs are problem solvers. Sometimes the bigger the problem you solve, the greater the opportunity and the bigger the profits involved. In this upcoming episode, we nerd out and we go deep into buying properties, scaling your business quickly, how to buy apartment units, how to be a meticulous operator of your properties, and most importantly, how to do the due diligence to make sure you're getting a good real estate investing opportunity. If you're interested in growing and scaling from single family properties to multifamily, this will be an episode you will come back to often. Make sure you hit that subscribe button and the bell notification not to miss an episode. So without any further delay, let's get right after it. Please help me welcome to the Russell Westcott podcast, Mr. Mike Everett. All right, everybody, Russell Westcott, welcome back to the Raising Capital Academy interview series. Got a really cool interview here to share with you today. I'm joined in the studio. We may have a few dogs barking and everything when the studio's in the home. So I'm joined here by a really good friend, Mike Everett. Mike has been, I would say that you've been slowly under the radar, been amassing a pretty big portfolio, but that's about to change. I think the word is out, Mike, of what's going on and what you've done. We have a lot to get through and a lot of information to share. But before I do, I just want to say welcome, Mike Everett. How are you doing, buddy?
I'm doing great. Thank you.
Good. Mike, we're going to get into what you've done and what you're doing and how you're doing it. But before we really get into all that information, maybe if you could just share with everybody watching. So everybody who's watching is going to be in different phases of raising capital. They're just getting started. They're going to be in the phase of maybe they've done 5 or 6 places and they're maybe looking for the next level. And then they're also going to be into the place where they're going to be scaling hundreds of properties and raising multi-million dollar thing there. I would say you're now transitioning into the scaling part.
Yes.
Right? Like significantly transitioning. So we have a really cool story here to share with you. So before we do get into all that, the how-tos, maybe give people a little background about what you're doing, what you're up to, maybe where you've come from to this standpoint, maybe some of your experience that have got you here.
So I think we bought our first investment property about 2010, right around the time we joined Rain. That's where we met.
Yeah.
And just a single residential, and it had a suite basement, but we gutted it right down to studs. I never picked up a hammer in my life. I call it the Home Depot Bible, the orange book they sell about housing systems.
Yes.
And I just learned from that. I just learned on my own and just did it. Took it right down to studs, rebuilt the whole thing. I did it. I think I spent about $15,000 in the entire suite, and then I got of that $15,000, I got $9,600 in rebates back from the government. Mm-hmm. So that was nice savings on that. And then just I rented out, and then all of a sudden all my debt evaporated because I was still living the same life, and I got an extra $900 a month or $800 a month for rent, whatever it was back then. Just a 2-bedroom basement suite, and all my debts erased, and I was hooked.
Right. That was 2010.
2010, just after the subprime crisis. So
yes.
Credit was still very liberal.
Yeah.
And we were able to leverage the first couple properties, like just basically own this one. We refinanced up to a certain percentage because we added value with the basement suite.
Yeah.
And we did other renovations as well. And then we kept that house. We moved into the next one. And we bought that one because of the subprime crisis. All the housing crashed. Yep. The prices adjusted. We knew it would readjust back, or at least I felt I had that instinct that it would come back, and it did. And we were able to buy another one with our in-laws. And then I think a year later, when the prices readjusted, we refinanced and bought another coach house. We were in the coach houses back then.
So in the Surrey,
Clayton Heights.
Clayton Heights. That was actually, yes. Did we not? We had, I believe at Rain, we had a field
bus tour.
Bus tour right around that time.
Yeah.
So was that around when you were you part of that, or did you?
Yeah. I was trying to think who my bus facilitator was. but I'm too old for that.
So guys, just here's something, just one point already. How many people, there maybe a couple hundred people that went on that trip. Not everybody took action. You actually took some action from there. Were you already owned a few of those coach houses?
Yeah, we owned two.
Yeah.
And then I've actually had two friends buy coach houses as well, based on advice. And I got another friend currently, now that they're at $1 million valuation, actually going to buy one this week.
Right. So for people that might not be familiar with coach house, what's a coach house?
Coach house is basically apartment on top of a garage behind the home.
Yeah.
Then you have inside the home, you got 3 floors, the basement, the upper floors. A lot of people in Clayton Heights will suite the basement. It's an unauthorized suite because you're only supposed to have your 2 in the city of Surrey, and that's before city council right now. So it's a risk if you do it now. So you have to know that.
Yeah.
But it's good moneymaker. The one we got, we were like $1,400 cash flow a month.
Yeah.
It was pretty good moneymaker.
So essentially it's called by many different names: garage suites, garden suites, laneway housing, different things. Essentially it's a suite above the garage, and then in where you were, people were actually putting unauthorized suites in the house as well. So essentially 3 rental units on one piece of property.
Yes.
Right. And no different than what's going on, we're seeing in Edmonton a little bit right now.
Yeah.
But a lot of people are not putting the basement suites in. They can do it unauthorized after the fact, but it can't be built that way. They won't get authorization from the city on that.
Yes, but like say when you put the basement suites in, just like say the biggest issue is safety, right?
Yeah.
So you always want to make sure you're up to code, and it's something you don't want to. It's a risk if you go unauthorized, but if you do it, just make sure the safety is there, and that's the most important thing.
Right. So one of the topics and themes that we're going to be touching on quite a bit throughout our present our time today is going to be around diligence and risk and all that kind of wonderful things. And you have a background in law enforcement.
Yes.
Right. So how has that helped serve you for this game of real estate investing?
I think it served well. Investigation, due diligence comes naturally. It's second nature. You can talk to someone and pick them apart, like in an interview or just talking to them. You can because you just consistencies, right? You just remember things. So with tenants, managers, real estate agents, so if they're not consistent, you can kind of get a flavor of whether you want to do business with that person or if you want them as a tenant. It helps. I mean, there's been a few that snuck by, and I've let my guard down. One was another law enforcement officer, corrections officer that I let in that I gave a lot of leeway to, just because I didn't follow up with a lot of stuff because of it, and she was probably the worst tenant I've ever had. And she cost me a lot of money. So you still got to do due diligence no matter what, even if they're law enforcement.
Yeah. So I imagine you get a pretty thick skin in in law enforcement, which it serves you well in real estate. The whole investigation and the diligence side of just you probably take that extra 5 steps where most people would stop digging underneath in the layers of things. You actually will dive even deeper. Yeah, and just because you've seen it, haven't you?
In the expression of peel the onion, I try to get to the core.
Right.
I just know that at every turn, like you have to, like, information is power.
Yeah.
You can't say that enough. And I remember in Dawson Creek, we were still buying houses at the time. In Dawson Creek, it was big, all the LNG push. They even made a ministry on LNG. So the impact of LNG in that area in Dawson Creek and Fort St. John was quite substantial. We bought a house there, and we got lower mainland rents for half the cost of the house. So it was a really good cash flowing house when we bought it. It actually still is to this day. But the great thing about a small city like Dawson Creek is they list all the major employers on the website. And of the 10 employers, I think majority of them were public traded companies, so you could pull their financials. So it wasn't enough that we did the economics for the area and what was coming. I actually confirmed I went through and pulled up financials, and you could see they're expanding, hiring more employee. Their training costs were expected to go up, and they were forecasting capital expenditures, meaning they were probably expanding. So it was just like little confirmations like that, like little nuances like that made me feel it was like another checkbox.
Right.
It made me feel more secure.
So there's as Barry McGuire would say, there's diligence, which is just enough information. Then there's due diligence, and then there's investigation. almost, right? And to the level that you're taking. We were talking, you're developing a software program to help take that another step forward as well.
Yes.
And maybe we'll talk about that towards the end, if that's cool. Okay. So no, I'm jumping around a little bit, but so 2010, first place in Clayton Heights. What'd you pay for that first coach house?
It was actually Langley House. Langley House, I think I paid, that was the lowest price building in the Lower Mainland.
Yeah.
Second the lowest, so it was one across the street was 10,000 lower when it sold. After we added the value, I think we paid $359.
Okay. That's what's your best estimate? What that'd be worth today?
$750.
$750. Okay. Which is actually still fairly low.
Yeah.
Right?
So we ended up selling it. I just recently sold it because we went into multifamily. So it's one of the houses we divested, and we used that money to buy multifamily. So we sold it for, ironically, $535 or $530ish. So it was good. It was a good. We made good money, and plus we held it for 5 years. Like after we moved from that house, so the rental revenue. I mean, I think we had about $150,000 rental revenue as well. So it was pretty good.
And then you said you've invested up in northern BC as well into the Dawson Creek.
Dawson Creek, yeah.
How many properties did you purchase?
Just one house, a single residential, 3-bedroom upstairs, and a 1-bedroom furnished downstairs.
Yeah. And so, guys, just. So humble beginnings, to say the least.
Yes.
8 years as a starting point. So guys, everybody starts wherever they start, but you might want to actually pay attention to a couple of these next numbers we're about to share. So you've been on a tear over the last 2 years or a year and a half? What has it been?
Probably a year and a half.
A year and a half. So you've been diving into multifamily proproperties.
Yes.
How many units have you bought in the last year and a half?
Well, 6 years ago, we bought our first multifamily.
Yeah, okay.
And then, which provided, the refinance that from the capital gain on that provided the impetus for this push on multifamily. So in the last year and a half, we've bought 8 more multifamily buildings.
8 in a year and a half?
Yeah.
And how many units?
Total 95, but 78 doors in the last year and a half.
78 doors. So you would suffice it to say you're now scaling.
Yes.
Right. And you probably had some of the capital yourself, which you divested things and refinanced a few things, but you've started raising capital as well, have you not?
Yes.
Who have you been raising your capital from at the moment?
Friends, family, business associates, a couple times a accredited investor.
Yeah.
It's been pretty good. And it's just kind of, it just happens. Like you just have to recognize the opportunity when it comes along. Yeah. And then you just have to, it's a no-brainer. Like if you know what you're doing and you recognize the opportunity, it's just, you just click, you just do it.
So I know you're being very humble and very modest about this, but we can suffice to say that 8 years you're an overnight success. And just getting started. You might even just think that you're actually just starting out.
Well, overnight success, no. Yeah. It's taken that full 8 years. Yeah. It's like, the way I describe it is like if you have an ocean liner in the middle of the ocean, and it has to make a turn. It doesn't turn on a dime. It takes some time. So when we switched from the single residential to the multifamily, or that focus, it took probably 3 years to set it up. And there was a series of things that had to be done. Like we sold off some properties, refinanced, and you add the new mortgage rules coming into that, because that's what we forecast was all. You could see the changes in the tightened credit market. Again, the more houses we got, I think we were up around 6 or 7 houses, and you could see how difficult it was. Anything above 5, it was like the banks were taking so much longer. We had to extend subjects a few times, so it changed the whole dynamic. So you could just see what's coming. So we just started divesting of the single residential. We went multifamily. It's a different tool, different sandbox, but the rules are consistent. Yeah, and that's what I want. Once you get a system, I just wanted to execute and repeat. And so we set it up, and then we went into it, and then opportunity, as we were going into it, opportunities kept coming up as we do this, and it's like when you have some success, it's like almost like it just attracts.
Yep, it's people in motion will attract other people to keep the momentum going.
Yes,
right. And honestly, I've been getting out again too, and I've been speaking at a lot of networking events in the Lower Mainland, and Mike is at every one of them. Yeah. And there's no coincidence why you're raising capital and you're meeting people and you're sitting there going, well, I'm doing this deal and I'm doing this deal. And all of a sudden, guys, I say this all the time. It's like you can see the people in action because there's Mike in the middle, and he's surrounded by about 5 or 6 people. And in those 5 or 6 people, you see the lean in factor where people are leaning in. Well, Mike is now becoming an expert. Not becoming, you are an expert. And people are now starting to be attracted to you. So you subscribe to the attraction method, not the pursuit method.
Yes.
Right.
Well, that's the way it's worked out.
Yes.
So it's taking me by surprise.
Right.
So.
Surprised, but 8 years of nose to the grindstone, and you were just saying that one of the things that you do is how about this for dedication? You were saying that once you put the kids to bed and play with the kids, and you got three young children.
Yeah, all under 5 and under.
5 and under, and guys, there's no excuses. Right? Having a family is no excuse. And you say sometimes after they go to bed, you put another how many hours of research and reading and stuff like that?
Probably 8 or 9 hours.
8 or 9 hours after the kids have gone to bed.
Most nights.
Most nights. So I don't think there's any coincidence that what has happened over the last 18 months.
Yeah, my pet peeve. Well, it's not really a pet peeve, but the one thing I don't like is when people tell you that you're so lucky. Mm-hmm. It's not luck. It's hard work. It's a grind.
Yes.
And the grind is when you don't want to do it, you're just so tired of it, and it's like going to the gym, right? If you're tired, you just don't want to do it, and you just gotta go. You just gotta do it, and then after you've done it, you whatever thing that you've done for that day, you just feel better for it.
Yeah. And someone comes to and says that whole you're lucky, without getting into it right off the bat, I just thank you. But they're, honest to goodness, they're actually doing a disservice for dishonoring the price that you have paid for the past 8+ years of all that work and time. It's really, they're being disrespectful.
Yeah.
To be honest.
The ones that, and then because I'm in law enforcement, then you got people that suggest corruption because they don't know how to do it. So they suggest because they don't understand it, right? So I'm like, I'll freely tell them. I go, just ask me a question. I'll show you how it's done. I go, I'll mentor you. I'll help you out. Just you got to put the effort in, and I'll help you out.
Yeah, most people will not do the work.
Yeah, that's the issue,
right? And it's quite interesting. Obviously, the person that says that the law enforcement and the corruption obviously doesn't know you, because from our conversations, I actually think you actually go too far because of your background in law enforcement. I guess there's no such thing as too far ever, but you actually take things to another degree of making sure that you're on the right side.
Yeah, well, I'm required to as well. So
yes.
I have like my oath to this country, right?
Yeah.
So what I do, so I'm required to take it to that degree. Like it's black and white on a lot of issues. Although I know there's a lot of gray area, but I like to keep it black and white just to be above reproach.
Yeah. So these partners you've invested with so far, they've been family, they've been friends. You said in-laws was one. Didn't you mention some that there was a neighbor or a best friend, a couple best friends?
Best friend. That's a cool story. He actually just won Rookie of the Year at Rain this year.
Oh, nice.
And I did and it was funny. We sat there and neither one of us knew.
Yeah.
Like he didn't know, and I thought he knew.
Yeah.
And I'm like, why didn't you tell me? And he goes, I didn't know. So it was pretty cool. So he's got his we bought 2 multifamilies with him. And he bought a coach house as well. And you would talk about sacrifice and doing what it takes to get ahead. He lives in the basement suite and rents out the top 2 floors.
Wow.
Or he lives downstairs in the basement, and he rents out the top floor and the main thing. And he actually gets paid to live in his house.
Nice. Yeah.
So yeah, and then that with the two multifamilies we bought together, he's now on paper he's a millionaire.
Wow.
Which is kind of cool.
That's
right?
fantastic. So it's just started by just within your first level of influence and people right? Yeah. And now it's branching out into people who and it's people of them, the friends and the families and the referrals. And now you're slowly branching into, higher net worth individuals and accredited investors and things like that. And you're meeting those through just the way you show up, right? And
just by showing up.
Yeah.
The meetup groups, Rain, just everyday conversations. Referrals are huge. Mm-hmm. People are always like, everyone out there is looking to take whatever money they have, and then they want to increase what their nest egg is, or whatever the amount they have. But a lot of them don't know how to do it. So when you have this skill set, you're sought after, and you have that track record to prove it. Like, it goes a long ways for trust and professionalism, and integrity plays a big role of it, like that trust, that trusting. Because I mean, they're giving you a lot of money, so you gotta be transparent, and you gotta just like say, I go above and beyond, and I try to be as transparent as I can.
Oh, that's awesome. And speaking of awards, which you mentioned, you were just mentioning some hardware. You just came off of the award ceremony at the Real Estate Investment Network, and you were up for 6 categories.
Six categories, and won 4.
You won 4, so it was
a pretty good year.
Toot your horn. This is your chance. Toot your horn, brother.
The one I was surprised, Renovator of the Year.
Yeah.
That was a sixplex in Prince George was the main one. We've done other ones in our other buildings, but the main one, we bought it for $270,000. It was practically free. And we've done the renovation, complete renovation, new boiler, new hot water tanks. One suite was vacant right to studs. We renovated that, new roof. We did everything. It's actually a pretty cool building now. And I think it's worth about 650-ish now.
Nice.
So that's what doubled the value, but we only 25% down. So we 400 to 600% return. I have to calculate the exact numbers in 8 months. Mm-hmm. That's pretty decent building. So anyways, we got Renovator Year for that one. Multifamily Investor of the Year. Obviously, the 8 buildings we bought. So there were some key players that weren't involved this year. So I kind of.
Well, the Western Canadian Properties Group, maybe
Western Wealth.
Western Wealth. Sometimes when they enter, it's a different category.
Dave's a good friend of mine. I like him. I respect him, and they're crushing it. So.
Yeah, Dave and I are going to be doing an interview as well. So
listen to Dave, guys. When you hear Dave. So. So he knows this. He knows what he's doing, and he's doing very well. And I guess he probably just didn't submit this year. So I think I was runner up to him last year. Mm-hmm. So. So it's the only reason. I think. So it's an honor to have it. But I know Dave's the king. And then I got the Leslie Clough Top Player of the Year award, and then I got, which was big surprise. Yeah. And
one of the top 10 players probably.
Pardon me?
Top 10 player?
No,
another one.
No, I got the top.
The top, and
Leslie Clough.
The top 10 as well, right?
Yeah. So I guess Leslie Clough, I think, is the top of the top 10. So
right on. So guys, he knows what he's talking about.
Yeah. So and then not co-venture. I didn't get co-venture this year. I got last year. Mm-hmm. I got Innovative Investor.
Yes.
Innovative Investor of the Year. So. Nice. Just the techniques you're using to buy the properties, and they add value. And so, I mean, we've added value to all the properties we bought. Like, say you make your money when you buy. Yeah. And
this isn't even a full-time gig for you, is it?
It will be.
It will be soon. Very soon.
I'm looking forward to becoming a full-time gig. So.
Right on. Guys, Russell Westcott here, part of the Raising Capital Academy interview series. I'm here with Mike Everett, who's just been on a tear over the last 18 months. And it's kind of a culmination of 6.5 years leading up to it, a lot of those things, and really coming down there. So I want to get into 2 waves of conversation here. The first wave I want to get into is people that you're meeting now and the deals that you're putting together, what you present, how you're attracting them, how you structure it. And then I also want to get into a scaling conversation that we've had, that you're looking to do a pretty big purchase. And you've been doing a lot of research in the background of raising capital from public funds. And I know neither of us are the ultimate experts on that yet, but I think you have a lot that you can share with people right now who might be getting started on that realm of raising public money. Okay, so first wave of questions. There are questions in there. Yeah. First wave of question is, so when you meet somebody, how do you present what your deal and what your opportunities are to them?
Well, the way it's been so far, generally people express an interest and they have the money.
Yes.
So they're like, you basically, you talk to them and you make sure that, they're not overstretching themselves, and you want to, like, I guess the securities guys would call it know your client. You try, you go over that, and you meet them, and you make sure that your goals are aligned and that you're a good fit for each other. Because if they're going to be worried and they can't sleep at night, they're probably not a good partner. Yeah.
The whole thing about the diligence and the questionnaires and the kneecaps, and you take a lot of time, because your time is very valuable. You probably take a lot of time to really vet somebody both ways. It should be work should be both ways. So how do you have any questions that you ask people, or how do you? Okay, let's play here for a second.
I know with FinTrack requirements, you're like, where's the money coming from?
Yeah.
Like, so generally most people I know, there is connection to me that I actually know fairly well. I kind of know where the money's coming from.
Yeah.
So but I confirm it. Like I ask, are you doing a refinance? Is it savings? Are you selling an investment or like another investment you already had? Like, so you're already in the space. So they're already that level of sophistication.
Yeah.
So, or, is it stock, where's the money? You have to determine where the money's coming from, because you're going to get asked for the banks and you're going to get asked for like the FinTrack requirements and all that. So you have to know that going in.
So that's one of the key criteria is where's the money coming from? Because it leads into the conversation that, if somebody's borrowing it, one of the conversations might come up is, well, are you going to be able to pay my interest on it? So you just need to know a lot of these things. So where the money coming from is key. What else is important? What do you need to know from an investment person? We're meeting, and I've said, Mike, man, I love you. Look at all those awards you've won. You're just crushing it. I have some money available. What would you do with me?
What are your goals?
Okay.
Are our goals aligned?
Yeah.
Can I meet your goals?
Yes. So two key things.
So, and then, once we are kind of on the same page, then I go see the project, because I'm the belief. There's a lot of guys that will go and make offers and they'll tie up a property, especially in multifamily world. It's a smaller universe.
Yeah.
And then they'll go raise the capital afterwards. Problem is, if you just once, you don't raise the capital and you don't close on that building, you have that rep.
Right.
So I've never made an offer on a multifamily that I haven't closed.
So you always have the money tied up. You have the money to buy.
Ready, and I have money to buy.
Okay.
And it's good to have that rep, right? So they know you're a serious investor, and that you're not wasting their time. That's important. My reputation, I think, precedes you whenever you put an offer. It also empowers your realtor that's working on your behalf. Like my one realtor that I use, I think I bought 7 properties from her this year. She goes there and she can tell him, she's, hey, he's bought 7 properties or 7 multifamilies this year. He's closed every one. So like it gives her that ability when she presents that offer, that you're not just kicking the tires. It's a serious offer.
Okay. So you need to know my goals to make sure that there's an alignment, right? You need to know where my money is coming from. You probably also need to know that this isn't my last $10,000 or last $100,000 that I'm
afford.
I can afford.
And there's criteria for that. I think we mentioned that like you want the criteria, like offering memorandum exemptions to that, you can raise capital from the public, but right now, like say everything's friends, family, and business associates right now. So but I want to go out into that realm to raise more.
Yes.
And then I guess you said we'll get into that later.
Yeah, we'll get into that maybe on segment 3, because I think there's a real key thing, because there's some things that I'm seeing out in the marketplace that are actually kind of a little scary.
Yes.
Where people are raising capital from the market, from the general marketplace, without having the proper background or documentation or knowing the clients. And we're just here to, one of the goals with this project that I'm working on is to defend and advocate for people in it, right?
Yes.
And to just make sure that we're all protected. And what we're doing is the last thing I want to see is, someone being, thrown, and you would probably never be thrown in jail, but, being slapped down by securities and things like that too, because you've gone too far and too high and just overstretched and things like that. Okay. So back to the conversation, our goals need to be aligned. You need to know where the money is. You need to know that potentially you'd show me a project, or maybe we'll go see it. What else do you need to know from me in qualifying me in order to make sure that we can work together?
What kind do you want to be? Do you want to be part of it, or do you just want to be a passive investor?
Great question.
So a lot of times people are inquiring they want you to mentor in the process, and that's and then they want to, I guess the next building they think they can do on their own, but they just want that, it's a confidence thing. Yeah. A lot of times, and then in that case, you just kind of spend time with them. Like you want to say, and if they can do it on their own, I tell them they should do it on their own. Like it's not about. It's if you think you can do it on your, then do it on your own. Like, but if you're aligned and you work well together, then by all means go and create a little empire together. So
the next, I would, if I was classify that, it would be involvement. Are they just completely hands off, or they want to be part of it? I've had.
Do they want to cash checks?
Yes.
Or do they want to be actually involved in management?
What kind of money do they want? Do they want money now versus waiting? So those are other expectations. Okay. Anything else that you would see?
Expectations is a big part. Like you like say, are they expecting a monthly check, or is it going to be like at the end of the project that you're going to evaluate it? Because a lot of them, I've just had this experience. Because you forecast numbers, right? But you tell them, say, you know what? The first year, 1 to 3 years, you have to expect the first 1 to 3 years is a stabilization time. Yeah. So it's not going to be that perfect scenario, because everyone always has, like, on paper it looks perfect, and like when it doesn't perform like that, it's a surprise, or they question it, right? And I'm like, well, we went over this. Like, this is the part. So you have to gauge the investment from the entire time, from the time you have it to the disposal, and then you can calculate it. And the first year is like the buying costs can be fairly high. Yeah. So you're looking for underperforming assets, because then you get a good price in the multifamily world. The sorry for the language, guys, but the shittier the operator that you're buying it from, the better the price might get. Yes. Right, but you can't turn that around overnight. Yeah, it's like the same analogy of that ship in the ocean, right? Yeah. It takes a long time to turn that ship. We're going through that process right now. A 20-unit building in Edmonton. The former owner, I believe, was there's some newspaper articles, like open source information that identifies him as a drug dealer. Of course. So, and there's the street level drug dealers in the building that we bought. So we've removed them. They're all gone. We have higher vacancy now as a result. So we're renovating that building, and we're creating it. So the good tenants that stay behind, are very appreciative. So, and by the time we flip that, we're actually going to improve the neighborhood. Nice. So it feels, it was kind of like, we bought the worst building on a good neighborhood. Yep. So not the best neighborhood, but like a good neighborhood. Yep. And we're gonna filter our tenant profile, and we're gonna raise the value of that building by quite substantially. Yeah. So there's two schools of thought. Some people don't want to roll up the sleeves and get into a really crappy situation, which is totally fine. Different strokes for different folks, right? Some people will maybe want to buy something brand new and turnkey, and Bob's your uncle. And what you're probably finding is some of those people that don't want to get involved and get their hands dirty are your best joint venture partners. Yes. Right. But then there's some good money to be made for rolling up your sleeves, sticking your nose in, hitting it just head on, and just dealing with the problem, right? We were talking about back to law enforcement. Yeah. I've seen everything. I've seen a lot. So I haven't seen everything. I've seen a lot, and nothing surprises me. Yeah. So when you go in there and people are doing what they're doing in that demographic, and it doesn't shock me. It doesn't surprise me. I just deal with it. I just take action, and you take action right away. There's no doubt about it. And everyone sees you taking action, and there's no hesitation in your mind. It changes and corrects a lot of behaviors really quick. Yeah. Especially when they get things wrong. They know the new sheriff's in town. Pardon the law enforcement reference, but they know things are going to change. And you run a tight ship, and you basically just want a safe house, safe place where people can live. Nice. And that's my goal. And you improve the lives of a lot of people there. Yeah. The drug dealers doesn't improve their lives because they get kicked out. Right. They can go find an absentee landlord somewhere else. Yeah, go find the landlord that stole from you. That's probably still got another property or two. They can go to my competitor and stay with them. So if you've been following the series, guys, you know that one of my definitions of a real estate entrepreneur is a professional problem solver. Yeah. All day long. That's what you're doing. And you get paid and compensated very well for being a professional problem solver. Yeah, it's pretty decent. You still got a lot of hair there, I see. So it feels like it's falling out. So, give you a few more years and get the kids a little older, and maybe a few more drug-infested apartment buildings. You might be in my same boat. But so really, and you also touched on, I just mentioned something as well. I think it's a critical point. When you're working with money partners, guys, you will come across it where somebody will always say to you, I think I can do it myself. Right? You hear it all the time. You know what I say to that? Go do it yourself. I think you can, and I think you should. Yep. Right? And I look at it as a rite of passage when working with
you and working with me, this is the goal I always want to have it with people, that a money partner working with myself thinks it's so easy after it's done that they can just go do it on their own. That's my goal, because I've actually had money partners that have worked with me, and after they saw them, they go, oh yeah, and then they went and bought their own place, and it was just, I'm not going to use the colorful language, but it was a shit show. Yeah. And they came back and said, here, just we'll work with you for the next ones, right? Because it just was so easy. That's the definition of professional. It's somebody who makes it easy, makes it look easy. Yes. Right?
I was going to say, you're the one making it look easy.
Yes.
That's why they think they can do it.
And those people will tell other people, because you want to be known as somebody who is easy to work with and somebody who performs and gets the job done.
Reliable and trustworthy.
Right. Absolutely. Okay. So if we just to reframe and wrap that conversation. So you need to know that we're aligned in our goals. You need to know that where the money's coming from. You need to know, for myself, that I'm okay with the asset class, that it's not going to be pretty and I ain't going to live in it. It could be some challenges. You need to know that we can work together and the timelines. You need to know the returns. Anything else? Is that kind of your whole filtering criteria with people, or is there a few more?
There's probably a lot more, but it's on the spot. It's you're going to miss things, and things will come up that you never thought of. Yeah. Every deal is different, and you learn from every single transaction. Right. You learn something new, and say, you know what, I'm going to try and do that different next time, or I'm going to not mention this or not do this stuff, or I kind of look at myself with another law enforcement analogy, like Kevlar, like. My job is to protect the investor.
Right.
So I put myself between them and any danger. Mm-hmm. They don't need to know information, because they say it'll stress them out, because they may not be used to that type of stuff. That's for me to deal with. That's why I'm the partner.
That's why you got the bulletproof vest on.
I'm the Kevlar. Yeah. And then I also protect them on the back end. Like, so they get their money out of the investment first. So if there is losses, we take the brunt of it. Yeah. We also take all the buying costs on up front. So the buying costs with such a multifamily, you're probably 20, 30,000 into it before you even close on the building.
Right.
And we do all the buying costs on our own and then their risk does not begin until we close. Mm-hmm. So everything we do, we design it to protect the investor.
Right.
And when you have when you have that mentality, it engenders trust. It engenders credibility, and that reliability. Right. So you're doing everything to protect them. Mm-hmm. So like you say, if you have an issue and you've solved it, even though it was a horrendous issue, and then you tell your investor about it, but it's already solved, they're like, oh, okay, whatever.
Nice.
And then it just, they don't care. But if you're telling them while you're doing it, and they're waiting and they're by the phone and they're freaking out, and you're just causing them stress that doesn't have to be caused, right? So, like say that shock value, right? So like say, it helps to have that experience and know how to deal with stuff and just execute.
Nice. So really, it's a very personalized, hands-on approach at this moment. The way it's structured right now.
Yes.
And rightfully so, it should be, right? Because it's a sorry for a Spider-Man reference, but with great power comes great responsibility. Right, huge. You're now in charge of somebody's potential financial future and their goals and their hopes and their dreams, and putting the kids through school and being free and clear in the house in Maui and all that kind of stuff. You're part of that now.
Yeah.
Right?
Your job is to make them successful as possible. Yeah. And by default, you're successful.
Yeah. You participate in them winning.
You participate in their success.
Yes. So
that's your only job.
And guys, I hope everybody wrote that down. You will have an endless supply of investors coming to you if you will always come from a place of doing what's best for them first.
Yep.
Right?
I agree.
And even though when it hurts and it's painful, and trust me, check out the whole module on beware of the dark side of all the mistakes. That's you can check that one out, where I'll share a lot of the mistakes that I've made along the way. And but just always having their interest in heart, putting their needs before yours. You eat craft dinner while they're eating caviar is okay. Like, that's part of the process.
I like craft dinner, so it's okay.
Right. So that is just all part of the process. So I mentioned something about a little bit of, and I'm going to segue here into that second wave of questions about structures.
Okay.
So far right now, you're buying with family and friends and your neighbor and parents and in-laws and accredited investors you've maybe met from a networking event or two. How many investors are you working with right now, just for perspective?
Probably a dozen.
A dozen,
or so.
okay.
Maybe
So,
15.
Yeah, so that's a really good number. How do you structure your purchases? Do you have corporate structures? Do you do personal? What's the primary mode that you're in right now?
Multifamily, everything's pretty much corporate.
Yeah.
We own one multifamily in our personal names, which we're surprised. Well, now I look back on it, was our first one. And now I look back and I'm surprised that the banks let us do it in our personal name. But we're insured, like we're readily insured for it. So we're that level of protection. I've been thinking about transferring it in, but everything's in corporate and everything's corporated. And then it's just a structure of how you do the corporations.
Yep.
I think I'm leaning towards the idea of limited partnerships, but right now we all own a corporation. We issue the shares. It's usually 50-50. And then the investors are directors, and then we're the officers of the company.
Okay, so
we basically do the work.
Okay, so just you said that really quick, and I'm slow.
Okay, that's okay.
So once again, let's come back to you and I investing. I would have my own corporate structure. You would have your own corporate structure, or the building is corporate.
The building's owned by one corporation, and we both own the shares.
And we own the shares of that. And
yes.
My corporation could own the shares, and your corporation could own a share,
yes,
or it could be
do
personal.
it that way. But then the problem is the way that's set up. It's already it's double taxation, right?
Right.
So it's a great way of doing it, and then I think it meets securities law because you're both directors in the corporation, well, so you're safe that way.
Yeah.
But it's. But like the double taxation, you get taxed at the corporate level, and it's passive investment.
Right.
So you get taxed there, and then you buy time money. So it's good, but it's bad. It's
okay.
There's better ways of doing it. Like with limited partner, you can have a flow through, like the way you do it. So it goes right. Where there's a loss or a positive. There's tax implications. Like it goes right. It's only taxed once versus twice.
Okay.
So you have to really look at the structures and limited liability partners. Like if you want a partner who just wants to cash checks and doesn't want to be involved in any management, limited partnerships are better because they're only responsible. Their liability stops with what they've put into the building.
Right.
So, but as soon as they took an active role in management, like the other ones, then they become as liable as I guess would be the general partner.
Okay.
So you want it depends. Like say that interview at the beginning, like say when you define what their role what role they want to be, that's important, right? So if they're going to be actively involved, then you gotta, it's going to be just a corporation. If they're not, if they want to be the passive investor and just cash checks, then you kind of want to probably a limited partnership.
Okay, so
talk to your lawyer.
Yeah, talk to your lawyer
or your accountant. Yes,
and guys, as you know, when you go into the interviews, I have multiple lawyers and multiple accountants that we're going to be interviewing and have interviewed. So there's a lot of depth in there as well. So that's why we employ them and pay a lot of money.
If they say something different than me, then take their advice because they're the experts.
Exactly. Okay, so let's go back to just. In rough, and I'm interested in how you structure it. You and I own a 12-suite apartment building in Edmonton. Okay, I've put up the money. You're doing all the work. Is it kind of a traditional?
If we're using our imagination, why
Yes.
don't we own a 100-suite building?
Okay, why not? Okay. But look at me playing so small.
Don't minimize. We'd say 1,000-suite building. It'll be multiple buildings.
Yes,
but you'll be like a neighborhood.
Okay, and. Do you work with it that I would have the capital in? Is it a 50-50? How do you typically structure? Or is it a everyone's unique, or do you kind of have a little bit of a model you follow?
It's pretty been everything been unique, but I've been doing 50-50 in the last couple. Just because I know the value I bring, and you have to know your value. And generally you have conversations with people, and when they have capital, they try to hijack the conversation and say, well, they want a higher percentage. And I'm like, well, I'm working for free. Like they don't know, like say we've talked about it. There's all the setup, the last of getting to where you are, like and all the books and all the readings. And like, I think I've 12 years in university, all undergrad, behind me, plus all the courses I've taken. I'm just finishing the exempt market securities course. I got to write my exam next week. So like all the effort and all the work goes up into that point. They don't see that. All they see is that they got the capital and they want a higher percentage. And I'm like, so I'm very confident in what I say, what I'm doing, and I know how to make their money more. So
writing the check is the easiest thing to do, potentially, right?
Yes.
And guys, you may not believe that, but if you actually probably looked at behind the scenes of what Mike does. And I'm sorry to cut you off there, but here's a lesson that I teach everybody to do is take 2 months and document everything you do, guys. Everything you do, because now you're just building your value proposition. That anybody who ever comes to you that's waving, I've got the $250,000 check, I need more. Oh, okay, you're bringing money. Oh, by the way, here's my long list of things I'm doing. Right. Yeah. So don't want to cut you off there. You're on a
it doesn't. You also have to recognize the money, where it came from, and all the effort they put getting towards that. So
true that, yes.
And they're trying to protect it. So it's a balancing act, but basically, their money still stays their money. Like it doesn't. It's basically just they're putting it into the project. They get it out first, and then we split the profits. It's not that we get 50% of their money. We get 50% of the profits after left over, and cash flow we split up.
And you just said also you're not coming into it with nothing. You fund about maybe $20,000. You fund all the upfront diligence cost. You actually are sharing 50% of the downside too. Yeah. Right. So, that's a big portion of it. You're also sharing the risk. Yes.
So they're going into it without any experience learning, and you're also sharing the risk with them.
Yep. So guys, don't ever discount the value you bring. So here's a guy who's, and I love having the conversation with business owners or the high net worth people, because they know what it took for them to get their money. They know the time and the effort and the sacrifice and the work and the education to do that. And I just frame it back of everything I've done within real estate is the exact thing they did in order to become, a veterinarian or a dentist or whatever. Of all those years of schools, that we've just done different schooling, if you really think about it. So this guy knows what he's talking about here. We're just going to quickly reset the cameras one more time. And honestly, I'm thinking this is... Mike, this could be like a 3 or 4 part conversation as well. So if you're getting some unbelievable value bombs here, make sure you put some comments in below. Before I forget, tell everybody where they can find you. Do you have a website? Or are you still kind of under the radar? Where can a person get a hold of you?
It's under the radar, but you can go to mike.everett@readybinder.com.
REDDI binder?
Yes.
.com. Mike.Everett.
And READY stands for real estate due diligence investing.
Yes, which is we're going to chat about that in a second. Okay, right back. All right, welcome back, guys. So we're here with Mike, and like every other interview that I've been doing here, this is turning into, it's going to be like probably a 3 or 4 part series. So are you okay if we do schedule some more time to get together?
Absolutely.
Right? Because all you have to do is come to the studio, and we'll just turn on the cameras, and away we go.
Sure.
Before we changed over the batteries and things like that in the cameras, you mentioned this thing called the Ready Binder. And you and I have had some conversations about that. So you've taken a lot of your diligence and your diligence systems and you've put it into, and you're developing. It's still early in the development phase, but you're developing a diligence system, which I would imagine the amount of diligence you do is one of the best presentation tools you can show to people is all the background work that you've done. So maybe just give a little bit of background about the type of diligence you do and what this Ready Binder is.
Ready Binder, Ready stands for real estate due diligence investing. It's a binder report. It's basically... It's like a kind of an Excel sheet on steroids. Mm-hmm. When you do your due diligence, because typically when you go to multifamily or single residential, if you're buying investment property, the realtors will put out pro forma numbers, mm-hmm. and they'll set certain amount of electrical, hydro, utility, or all the utilities at a certain amount, and insurance at a certain amount. The taxes are usually the previous year's taxes. It's never the current year's taxes or the forecast taxes, because in multifamily the net income is determines the value of the building, right?
Right.
So a lot of times these guys will do these, I call them artificial cap rates, like where they'll dress it so it addresses a certain market cap, and then they always think it's actually a premium when you actually divest or do whatever things. The rents are usually lower than what they are, the expenses are higher than what they say, and that actually lowers the value of the building. So when you do due diligence, you have to confirm every single piece in that document. And when you do that, you're protecting yourself and your investors, if you have investors, that what you're buying is going to perform the way you've seen it. And it's during that due diligence process that you can identify other opportunities as well. That 20-unit building I told you about, there was a five bay garage on the back that they were using for personal storage. One of our conditions on our subject when we offered on it was they to remove all the garbage. I mean, they call it. Mm-hmm. building stuff that they can use to fix on the building, but it's really just, there was 6 tons of material in that back, the back garage. They failed to remove it. I removed it myself. So that's why I know it's 6 tons. I went and loaded it. Yeah, it was fun. But it's, what it was, that's, those garages will rent out probably $200 a month. You look at the U-Haul storage place, there was like, or the storage place probably down the road for $300 a month. You get a place that's half the size of what those garages are for $300 a month. So I just conservative estimates at $200 a month times 5. It's $1,000 in a 5% cap market. That's a $250,000 value add on that garage alone.
Yeah.
So like say due diligence provides opportunities. So when you're writing, and then I write this business plan. So my report, the JV report, that binder report, it's kind of like a business plan for the building to the bank.
Right.
So that you can establish that you know what you're doing. So I go through the economic fundamentals of the area I'm buying. So I do Alberta, and so I pick Alberta, then I pick the city, and then I pick the neighborhood, and I break down the reasons why I'm there.
Right. Or sorry if I'm going to put you on the spot here, and feel free to say no. Would you be able to feel comfortable if we actually would post an example of one of these reports for everybody? Would that be, if people could just download and look at it?
Sure. Yeah, that's no problem. Like I would maybe give it a frame.
Yeah, absolutely.
Just like the frame of what I use.
Yeah.
And because it's what the binder report does, right? It does it for you. And then basically you have appendixes where you do detail. Yeah, you have your number sheet, which is one part of it, but your diligent background, why you're there, and then you identify that every building's got warts. Yeah. So I identify it. I'm transparent about it to the bank. You can probably not show the bank, but one time you're wrong one time and they find out about it,
right?
And you know about it, your credibility's gone.
And you were saying that your last application for a loan was, what was it, 700 and some? How many pages was the documentation?
They average between 300 to 380 pages,
right?
Or 200, 280. We'll call it 200, 280.
Right.
But that, like, it's exhaustive. It takes me just to write it. It takes me 3. And that's all your personal information, like all your banking records, all your, everything is in this. Like you could assume identity with this document. It's a very private document. So when you give it to that bank, you got to make sure it gets to the bank. So they could assume identity with identity theft and that. So that's my cop.
Yeah.
It's a very personal document, right? So in net worth statements, cash flow statements, everything, it details everything, your T4s, your NOIs, your what do you call it? You're on the rental property comparison, the last 5-year comparison. It gives everything.
Right. So in order to play with the big leagues, you got to step up, right? Yeah. You got to start playing in the big leagues, right? Yeah. Sorry for the analogy.
Yeah, no, that's great. But the great thing about it, the system, like last year, these 8 properties, I saved $500,000
right
in down payments. I've got 15% down on I think 3 or 4 buildings. 3 or 4 buildings. I've got 40-year amortization. I've never got less than 35-year am on any of the buildings because. So
think about it. You're de-risking it for the bank.
Yes.
So as we all know, in the interviews we've done with the banks, the less risk, the better terms, easier to get, better terms, better, cheaper money. Yeah. So you're de-risking it for the bank.
Yeah. The last year we've got through all our buildings in Edmonton are CMHC approved. We got through it the first time. And the bank actually argues on our behalf to CMHC.
Wow.
Which is it's a pretty cool thing.
And I would imagine, because in the world of commercial financing, there's fees attached to the broker putting together all this package to go shop it to the lenders, right? Yeah. So you're making it easier for the broker.
My broker loves it.
Right.
He actually, I've actually got tired of doing it. And then the last deal, I'm like, do you need a binder report? He's like, hell yeah. So I'm like, okay. I mean, I did it, but I was so tired. Like, there's so much work that goes into it. Like, it takes a while, right? So and it is the Achilles heel. Like in a hot market, I have to adjust because right now it's in Edmonton's a recession. So I've been able to get away with the longer closing periods. Mm-hmm. But I think in a hot market, I'm going to have to adjust and maybe not do CMHC on the first one, use private money.
Right.
And so, I mean,
close on it, then refinance after.
You're always evolving. But when you do that, you know that you're leaving money on the table because you got to pay upfront mortgage fees and carrying costs, interest only. So it's like that fault economy when you're just paying interest only, you're not paying anything down.
You even shared when we had lunch the other day, you shared a story about that in this diligence, you were able to identify an over usage of water on on that, and you were able to get that information before you even bought it, which then corresponded to a lower down payment, or maybe share that with me.
There was the building we bought was really high water bills. It was like extraordinarily high. It was like 550 cubic meters a month. It's a 15-unit building. And it was weird. So, but I knew the owner had just changed all the toilets out. So so you would go from the old 12-liter flushes to like 4.5-liter flush. So, I mean, that's going to be a big difference in water. But there was a leaking pipe in the boiler room.
Yep.
It was basically this little pipe that comes down, and there was about an inch between the pipe and the drain.
Yep.
So basically was in the building for an inch, and then went into the drain.
Okay.
And then I did, my engineer actually located it when he was doing the inspection, and he gave me a little video. And from that video, I was able to calculate volume flow analysis. I think it was like 2,340 liters per month.
2,400 liters per month of wasted water. Yeah. Okay. Yeah.
So I basically fixed it. Yeah. The seller fixed it. He's actually another Rain member. He got a pretty good reputation. Yeah. Anyways, he fixed it. So his cost it was probably $100 to fix it. So it wasn't like a big cost. But then I did the calculations, because EPCOR in Edmonton gives you basically the cost for everything. Yep. So just based on the volume flow analysis, you can just do the math and just do calculate. And I think I calculated within plus or minus 5 cubic meters of what it should be. And actually, so the very next bill that came in while we're doing the process, because they say it's longer with CMHC, actually confirmed my numbers, and they raised the value by $136,000. And that's $136,000 on the lending value.
Yeah.
So the way lending value works. So if you have a $1 million building you're buying, and you have your 25%, $250,000 down, but CMHC comes back saying it's only worth $900,000.
Yep.
So that $100,000 different spread comes off your down payment, and then you only have putting a $150,000 payment on a $900,000. So you're actually only putting 15% down.
Yeah.
Or whatever the percentage is, and then they add the premium on, right? Yeah. So you're actually responsible for that spread on top of what your down payment is. So that potentially I could have put that, I would have had to come with $136,000 on top of my 25% or whatever percentage they put down. So, but they actually raised the value, and it allowed us to close the deal.
Oh, mind blowing.
It was very cool the way it worked.
I actually have the headline. If you actually want to write this as a sales line. How you can fix 1 inch and generate $136,000 more in lending value.
There you go.
Right? If you think about it, you fix that 1 inch pipe, and you took the time. So guys, just wow, what a wonderful story on the lengths that you can potentially go to increase the values.
Do you know LHE in Fort St. John?
Nope.
Her nickname for me is Drip.
Okay.
So that's among my friends. It's a joke now, right?
Right.
So, and I'm thinking, I was all excited when I explained it, but they all took it as a joke. I go, you call me Drip all you want. I saved $136,000.
Yeah, in down payment capital.
Yes.
What would the valuation obviously went up, because in the multifamily world, every dollar you increase income goes up, and a saving of $1 is the exact same as an increase of a rent.
Well, in Edmonton market, it's about 5% cap. So for every dollar you save or you increase net income by either reduce expense or increase income, it goes up by $20.
Right.
The value goes up by $20. So it's that 5 to 1. The 5% cap is reverse ratio is 20 over 1.
Oh boy.
So
wow, this guy knows what he's talking about, right? So one of the conversations that I wanted us to get into, and this was another conversation we had at lunch at Boston Pizza over there, and we're first going to put a caveat on it, as guys, we're both we're not going to sit here and express that we're the end all be all the experts of this. We're both actually going through the same process of learning about raising capital in private markets, and there are. Guys, once you start going past family and friends and accredited investors and all these kind of different things, it's a different animal, and you need to be protected.
New laws,
yes,
this stuff. Even family, friends, business associates, it's called that exemption. There's still requirements under the securities laws.
Yes,
offering memorandum exemption, and then there's accredited investor exemption that you have to be able to prove they're accredited investors.
Yeah.
Number one, they're very clear about that. You have to be able to prove it. So you have to take notes, and you got to make sure you do your document how they did it, and they just can't say they're a accredited investor and you go, oh, okay, that's great, and then just do it. And then there's the risk disclosure forms now.
Yes.
And the only reason I know that because I finished the course.
Right. So we're going to get into that now. So friends and family, close personal relationships, things like that. What do you need to get as the real estate expert from me? Let's say we're close friends. I have the capital. What documentation do you need to get from me in order to move forward with a potential deal? Do we really have to sign anything, those kind of things?
Well, the agreement, you do the agreement.
You have a joint venture agreement.
Joint venture agreement or a shareholder agreement.
Yep.
And whatever, and the terms of your agreement is what you do. Is I put it so they get the money out first, and then and then with the capital we put in the beginning, that comes out next, and then we split up the profits, right? Yep. So there's the biggest thing, I guess, with friends, family, benefit, and business associates, because the trust is already there, but it's the risk disclosure.
Yes.
So you have to kind of go over risk disclosure. And that's where I say I want to improve. So you always do it verbally, but you want to have that written record of it. And there's actually a National Instrument 45106 on the securities. They actually have forms that you can do that risk disclosure with.
Okay.
It's already pre-formatted. You just press print and just fill it out.
So say that again slowly. Again, where is that document?
BC Securities Commission.
Yeah.
It's National Instrument 45106, and then it's form. And there's I think Form 12 is credit investor. Form 6 is friends, family, business associates, and then maybe I'm thinking form. Anyways, there's another one for eligible investors that are offering memorandum exemption.
Okay.
So there's different rules around each, which qualifies as each one. So you have to, so you basically you got to write notes, and then the way you do it, it just makes life easier, and then it bulletproofs you, right? So if something bad happens, and then there's a complaint to the Securities Commission, that's generally how it happens. When complaints go in, it's because someone lost money. And then when they come in, they'll talk to you, and you basically show them your documentation. They said, yeah, we went over this, It protects you, and protects your reputation.
Yeah. So really, at the bottom line, a lot of these things, they're just there is that to prove that you've disclosed to your investor that there are risks, things can go wrong, and that they feel comfortable getting involved with this, and that they just didn't buy into a really slick pitch. Yeah. In essence.
Yes.
So you talked about some terms called eligible investor. What's an eligible investor?
Eligible investor.
Now each province, just an FYI, each province has different rules and regulations.
A lot of them are standardized, but Ontario seems to be different on a lot of things. And there's Alberta's a little bit different. BC's there's a cluster BC, Yukon, Northwest Territories. Yep. I think Saskatchewan was in there. Say confirm everything. I think they're kind of more liberal on it. It's but it's eligible investor. It's either by income or by net assets.
Right.
Net assets is over $400,000 net assets. Okay. Or in income, it's $75,000 a month for an individual, or as a couple, as you and your spouse, $125,000. Okay. So that gets, and the reason I know is because I'm writing the exam next week. So I've really studied on this.
So we're doing this. There's a document that you would get me to acknowledge these things,
and that's through the offering memorandum exemption. So and then offering memorandum has its own set of rules that you have to when you fill it out. And that's actually my ready binder. I used to call it the JB binder report, but it's gonna morph into more of an offering memorandum side.
Right.
So it's gonna be electronic notes as well. So this, of course, it's causing me to pivot. Say you pivot you learn new stuff and you pivot and you just incorporate it.
Right.
So it's new information for me. So I'm going to incorporate it into my my report.
So really, what you're just doing is you're just documenting everything, no different than law enforcement with your notepad and all your notes. And,
keep notes.
And as they say, I had a friend who was a roommate that was actually in law enforcement, and he said he was more admin work than actually law enforcement work. Right? Yes. So you're just documenting the entire process. You're documenting all the risks, and you're getting acknowledgement from the person that you're working with. So that if you ever came down to the fact that you had to prove that you shared all the risk, if things went totally south, right, and the poop went through the fan and it went through the fan, that you could sit there and go, I shared all of the documentation, and here's my notes about what I did to share with the risks that can happen.
Securities laws exist to protect the markets, the integrity of the markets, and that's why they do this. I kind of disagree with them that exempt market, they call the exempt market risky because they don't have any control over it, and it's probably where a lot of fraud guys and the slicksters, as you call it, operate. And that's, and I get why they do that. So, but they look at real estate as a high risk. And I'm like, well, yes and no. I say you can mitigate your risk to next to nothing if you do your due diligence.
Yes.
But you have to do your due diligence. So in my mind, I disagree with their risk profile, but but that's the way they treat it. So you got to go by the way they treat it.
Yeah. Now you mentioned something, offering memorandum. What's for people that might not know, what is an offering memorandum?
Offering memorandum is a way to raise capital from eligible investors and accredited investors. It's basically it's like you're trying to put it's short of a prospectus. A prospectus gets registered with the Securities Commission.
Okay.
So and they're cumbersome and expensive, and they require like there's certain filings you have to do like every quarter, every annual audit reports. Every quarter you got to put statements into the Securities Commission and to all your shareholders and that. Offering memorandum is less stringent. It's not reviewed by the commission. It's just basically you have to cover this documents, and once you raise capital, I think you submit it to the commission, but they don't regulate it. They don't administer it, so to speak. Is on the same level as prospectus. Prospectus, like you can trade those securities in the public market. You can it's stock exchange and everywhere else. Where in the private placement market or exempt market, you can't. It's usually you can restrictions on resale. So like the higher risk, you can't get rid of the asset. So that's one of the, I guess the risk profile for when they identify exempt market is riskier.
Is liquidity is
liquidity
Yeah.
test.
So they deem something that's not as liquid to be more risky.
Yes.
Because they want a consumer to be able to, if something is wrong, they want to get their money out tomorrow.
Yeah. So
right.
And then talking about the eligible investor, and this where you have to be careful, because in some provinces like Ontario, like if you're only an eligible investor, you can invest $10,000 on your own, and then I think if it's on or offering memorandum, it goes up. Verify this because I haven't really looked at the securities because I'm in BC. I haven't looked at Ontario. You can go up to $30,000, and then if you have advice of an exempt market dealer or another dealer, like securities dealer, licensed dealer, you can go up to $100,000. Like if you receive advice, but that's like you're kind of cut off, right? And that's once per year. So there's limitations of what you can do. So and I kind of agree, kind of disagree with it. So if you're not a sophisticated investor, or it's that I agree that it protects you, but if you're trying to change your upward mobility, it makes it difficult because it puts constraint on it. So I kind of it might be a charter infringement with the mobility rights. So it's a balancing act, and I think they walk that fine line. So
so needless to say. And I chuckle just inside. No, and I this is very good conversation. Needless to say, this is a new rabbit hole.
Yes.
Right. And it's a deep rabbit hole. And one that I'm committed to getting, exempt market dealers. I'm committed to get the best of the best and interview all them. But I'm also, I'm just fascinated. I'm curious by the process because, like I said earlier, is one of the things we want to do is we want to protect you, right? We want to protect everyone who's raising capital out there. We don't want you off doing, things, in public venues and people that you've never met before, and you're offering, referral fees, and you're getting promissory notes from somebody you've never met before, or you're just asking them, well, how many bathrooms do you have in your house? Okay, check. I know what they have in their house, and it's just we just want to do this above board, right?
Yeah.
But it is a deep rabbit hole.
Yeah.
And you are taking your exempt market dealers.
I'm doing my exempt market professionals course.
Yes.
I'll be certified, but I won't get licensed because it becomes like say under the securities laws, if you're raising capital for your own benefit, like if I was licensed and I was raising capital for my own project, it's a conflict of interest anyway. So there's no, and I don't want to be an exempt market dealer. I want to raise capital for my projects, but I don't want to be so I'm okay. If I was licensed, I could raise it for myself. And you could probably argue that you could do disclosure about it, but it's kind of a moot point. Like it cancels itself out. So it's like I want to behave like an exempt market dealer because I know I'm following the law. But I'm not going to be licensed. I'm going to be certified. But I'll be an issuer, and I think as an issuer, they call it issuer. When you're raising security or selling securities, or you're raising capital through the offering memorandum exemption, the credit, all of the exemptions that are offered. You want to make sure it's, you want to behave like that EMD or the exempt market dealer. And then it's kind of like bulletproofs yourself. It's good for your integrity, and it's good for, it's just better. Like it's, and it's like, if you do get audited, it's like almost like a reaffirmation that you're doing things properly, and it shouldn't actually enhance and be a competitive advantage out there.
Nice.
Because you can say I've been audited, and but they don't want to say that. So, you need legal advice.
Yeah, absolutely.
So I can see I'm like seeing the tangents we're going off on here, and I'm like, yeah, you need legal advice. And there are guys that specialize in this, like there's lawyers.
I'm making a commitment that we will get that, because so we both can learn.
Yes,
right?
Absolutely.
And I am also sensing that we're going to have another conversation after you've taken the test and you've gone through that process as well. We're going to have another conversation. We've gone down some pretty deep deep topics. We've talked an awful lot about raising capital. We've talked about some structures. We've talked about how you can actually protect your investors, how you put your investors' needs first. We talked about how you protect yourself. Really, I'm framing this whole conversation into really, if you think about it, it could be the Kevlar conversation, right? And the protection of this, and how do you operate as a real estate investor? Okay, so we're going to wrap things up here, but I just have 2 lines of questions left for Mike. And the first one is, so you've been doing this now for more than 8 years. You've had a lot of success just recently. You've probably made some mistakes yourself, and you've seen people make mistakes. What would be some of your best advice that you would share with somebody, and some of the mistakes you've seen that have been made, and just, don't do this, if that type of advice?
Well, number one, you're going to make mistakes.
Yes.
Just expect it.
Yep.
Work with it. Get ready to pivot. If you're going to avoid making mistakes, you'll never get it. You'll never actually pull the trigger. So you're going to make mistakes, and you're going to do 1,000. It's okay. That's your best learning.
Yes.
Whatever you read in a book or you read in courses and that, it's great when they go over it, because then you can avoid those mistakes. But you're going to make all new mistakes.
Right.
So just you're guaranteed to make mistakes. I've made a ton of them. I've learned from them.
Yep.
And I share them with people as much as I can. I'm trying to think of just ways of doing things, like refine it. Like I've sold a house, one of my coach houses. I ended up selling it to raise money to buy multifamily. A year later, the market went crazy.
Yeah.
So, like, say the market indicators, like it's like, so I consider that as a big mistake, because I could have actually refinanced that house with a new value, got the same amount of money when I sold it, and still own the asset.
Yes.
So you really got to evaluate when you sell an asset. My attitude is I only sell when I want to increase the asset class. I made the difference up with my next purchase, but I could have made more money if I would have just held on, refinance. But you never know. Like, hindsight's always 20/20.
Yes.
And that's one thing you're going to learn. When you're making a mistake, you don't always know you're going to do it. You're doing it. So just expect that it's going to come on. Just don't freak out and let it discourage you. Just work your way through it, learn from it, and you take advice from other people. Yep. And what they've done. And sometimes mistakes are funny, and sometimes they're extremely punishing. I mentioned it earlier that the one tenant was a peace officer, so I gave her a lot of latitude, and it was the worst tenant I've ever had, which is surprising, because that's family to me. Yeah. So and I got hurt. So $40,000 in damage to my house. And that's only what I knew about. There was a flood that I found out about afterwards, which is probably another $2,000 or $3,000 in damage that she didn't disclose.
Wow. Right.
So,
hello, Scooby. So he was actually quite quiet for the long in the very beginning. So this is live. We're going to keep that in there, by the way. So before I do wrap it up, I wanted to just ask you one more question, and then we'll slowly wrap this up. Number one is, what final piece of inspiration would you offer to somebody who is 3 types of people watching this? Someone just getting started, somebody who has had some accomplishments and they've got a few under their belt and maybe looking for the next, and then somebody scaling. What would be your best piece of inspiration that you'd have if somebody's feeling a little bit stuck right now?
Keep at it.
Yeah.
It's like drinking from a fire hose.
Yes.
There's so much information. It's voluminous, but you got to take one gulp at a time, metaphorically speaking, and, to quench that thirst. There's so much information, and the more I learn, the more I realize I don't know. So if you ever think that you know it all, you recheck your attitude, leave it behind, right? And because you don't know. I mean, I got 12 years university. I take every course I can. Like, say, just finished exam securities. Like, I read a book, like probably 2 or 3 books a week. And the more I read, the more I realize I don't know. So, right. Like, it's overwhelming, but you just got to keep at it. I probably go to an extreme. You don't need to go as far as I do, but you need to know what you're doing, because when you know what you're doing and you put it all together, you recognize opportunities that everyone misses, and that's where you make your money.
Right.
Like when I talked about information as power, everyone else skips over something, and you swoop in, boom, you stabilize or you redo something, and you get your money, and if you buy properly, it buys you the next property. It's like Domino's Pizza. It's or Panago or whatever. It's like 2 for 1.
Right.
I used to work from as Panagopolis back in the end of the day. It was like 2 for 1 pizza. So I use that analogy. So that building I bought in Prince George, the sixplex, that's a 2 for 1 analogy. Or when I refinance, get my money out, I'm going to get a second building for free. So it's 2 for 1. Or I'm just going to take my money out and I'm going to own that building for free and actually probably get paid to have bought that building.
Wow.
And then I get cash flow forever until I decide to sell it. So when you buy, but knowing that information and knowing that opportunity and pouncing on it, so never stop learning. Even if you're not buying properties, if you're spending the time learning and doing that due diligence, like the due diligence also includes research.
Yeah.
It will identify opportunities for you later on.
Yeah. I just heard some just recently that really resonated with me. It's not timing the market, it's time in the market.
Yes.
Right. So, if you're not in the game, you can't win the championship.
Timing is a big part of it. Like say aligning with investors with deals and that, like that's an art as well. So, but like say the best thing is like just keep taking one gulp of that fire hydrant water at a time, and eventually you're going to quench the thirst, and you actually might become bloated.
Yeah.
So
well done.
And that's where you want to be. That's an okay position.
Nice. So I just wanted to acknowledge and just thank you for taking time. This has been a couple hours out of your time to come here, and for you to just so openly give and share just speaks volumes to who you are. I'm just very honored to see the progress that you've made. One of the things that I always love to see is, as I like to consider myself a teacher and an educator, and I often view the successful teachers are 100% relied upon the students on how well they do. And you know what, you're one of the best out there. And so I wanted to just acknowledge of all the work that you've put in and everything you have done. It's fantastic. So congratulations.
That's a two-way street though.
Yeah.
So I mean, I was at Rain. It wasn't until recently we started talking personally, but I mean, I've watched you for 8 years, right? So I've never heard a negative thing about you. So like credibility in my world, and for me to vouch for someone is like a mafioso saying he's a friend of mine. So I've watched you for 8 years. No inconsistencies, that integrity thing I talk about, you got it. So I've learned from you, like in the past, I've been the audience out there when you're up there teaching. So, thank you. Okay. So you're part of my inspiration.
We're gonna have a big bromance session here. So it's funny. We're both having a hard time accepting a compliment. Right? It's just part of who we are. Maybe
just humble.
Yeah, it is. It is all about, and that's what we're trying to accomplish at the Raising Capital Academy is bringing more people like Mike out and just sharing the good, the bad, and the ugly, and just inspiring people to take the next step. So once again, thank you, my friends.
Thank you. Appreciate it. Thanks for having me.
Guys, Russell Westcott signing off. Remember, #JVJedi, and hook up with Mike if you get a chance to talk to him very shortly. All right, guys, bye for now. I sure hope you enjoyed this in-depth training video, and I applaud you for sticking around right to the very end. I believe in people that show up, put in the work, put in the time, and effort should be rewarded. If you're interested in taking the next step, if you're interested in going deeper and mastering what you just learned about in this training video, I encourage you to check out the Raising Capital Academy. So if you have found that you've received some value from the YouTube channel, or maybe you've listened to a podcast, you're only scratching the surface. That truly is just 1/10 of 1% of all the content and materials that have been created that are waiting for you on the other side. So I encourage you to check out the Raising Capital Academy. There's more than 100+ hours of video content, audio content, exclusive training material for those that are interested in taking the next step, those that are interested in going towards mastery, those that are interested in moving forward with velocity. So I would encourage you, wherever you're watching this video, around this video will be a link where you can check out all the details of the Raising Capital Academy. after you've checked out all the details on that page and you're interested in moving forward with velocity, click on the link that will take you towards the application. This is by application only. This is a community program and is for serious action takers only. So if you want to step up your game, if you have goals and dreams and aspirations for more, if you'd like to make a difference in the financial futures of the most important people in your life, I highly encourage you to check out the Raising Capital Academy. Click on that link and you'll be taken to the next step in the process to see if you qualify to take the next step forward for you. Hope to see you on the other side. Bye for now. Well, I sure hope you enjoyed that video. 2 simple things to do from here. If you're interested in continuing your journey, interested in continuing to become a successful real estate investor, just below where you're watching this, there will be an opportunity for you to subscribe. And if you're interested in continuing your journey, there is a hand-selected video over here for you. It's been hand-selected for you to keep your journey going forward. Thank you very much.